Thank you, and good morning, everyone. 2023 was a remarkable year for SOFI. We achieved multiple records and realized many of our aspirations despite seismic geopolitical and macroeconomic events. We reached GAAP net income profitability in the fourth quarter and are positioned to continue to drive positive GAAP net income in 2024. Total members and products both grew over 40%, with 2.3 million new members in 2023 for a total of 7.5 million members. Our financial services segment achieved positive contribution profit in the third quarter, which ramped further in the fourth quarter. In lending, 72% of adjusted net revenue was from net interest income compared to 48% in fiscal year 2022. Net interest income offers a more recurring and predictable cash revenue stream compared to non-interest income. To put some of these achievements in the context of a longer-term perspective, I'll note the following. When comparing our business to fiscal year 2018, which is when I joined SOFI and we embarked on our new strategy, we have grown annual adjusted net revenue by more than 8x, annual EBITDA by almost 3x, or $660 million, members by more than 11x, total products by 16x, and consolidated net interest income by nearly 5x. Our deposits grew by a record of nearly $3 billion in the quarter. Tech platform segment revenue growth accelerated to 13% year-over-year on its way to 20% next year, with a 32% contribution margin versus 20% in the year-ago quarter. Personal loan originations grew 31% year-over-year, student loan originations grew 95% year-over-year, and home loan originations increased 193% year-over-year to $309 million. Over 50% of our newly funded SOFI Money accounts are setting up direct deposit by day 30. This account primacy drives spending, which exceeded $1.5 billion in the fourth quarter. This is up nearly 3x year-over-year and represents more than $6 billion of annualized debit transaction volume.
We saw continued year-over-year leverage in stock-based compensation, dropping to 12% of adjusted net revenue versus 16% in the prior year period, on our path to our longer-term goal of single-digit stock-based compensation margins. The 218 basis points of cost savings between our deposits and our warehouse facilities has resulted in a meaningful benefit to our net interest margin. It also underscores the benefits of having the option of holding loans on balance sheet when advantageous and collecting net interest income. Our personal loan borrowers' weighted average income is $171,000 with a weighted average FICO score of 744. Our on-balance sheet 90-day personal loan delinquency rate was 56 basis points. Our on-balance sheet 90-day student loan delinquency rate was 13 basis points. We assume a contraction in GDP in 2024, an increase in unemployment to higher than 5%, and broadly, a continuation of uncertain capital markets activity and continued normalization of consumer credit. From an interest rate perspective, we are assuming 4 rate cuts in response to a contracting economy, higher unemployment, and deterioration and normalization in credit performance, with Fed funds rate reaching approximately 4.5% by Q4 2024. We are taking a conservative and pragmatic approach toward our lending segment revenue, expecting to largely maintain it, given our concerns about the 2024 macro environment as it relates to uncertainty on rates, the economy, and industry liquidity. Fortunately, the scale and profitability we have achieved in our tech platform and financial services segments allows us to intentionally limit growth of our lending businesses in periods of uncertainty while still maintaining an attractive overall growth rate, significant profit, cash generation, and book value growth. For the full year 2024, we expect expenses under the EBITDA line to be roughly equivalent in aggregate in dollar terms compared to 2023, excluding the 2023 reported goodwill impairment expense. That equates to full-year GAAP net income in the range of $95 to $105 million and GAAP EPS in the range of 7 to 8 cents.
Some things that could give us tailwind. If we do see rate declines, our home loan business really would benefit from refinancing in the mortgage business and would benefit from greater purchases. Yeah, I think that there's 2 important indicators for the long-term earnings power of the business, which is what have we done to date, and then what's the sort of incremental way to think about profitability. The margin could be much higher than 30%, but we're sticking to that as our long-term margin today. As I think about 2026 and that time period, A margin profile in the 30s is what would help us get there and would make it achievable. But we're not going to push it higher than that because we want to make sure we hold ourselves accountable to some constraints on what we invest in while balancing growth versus profitability and marching towards higher ROE and greater tangible book value growth. The benefits of our strategy resulting in a uniquely diversified business that is unmatched by any digital-only provider in our scale, capability, and competitive advantages not only position SOFI to be the winner that takes most in the sector transition of financial services to digital, but also provide greater durability through a market cycle. I'm excited about where we are today and even more excited about where we can go from here. Thank you for dialing into our call, and we look forward to talking to you next quarter.